There is a meeting that never made the news. No press release, no CNBC segment, no tweet from a government official, just a small group of the wealthiest energy investors on the planet, sitting in a private room, quietly moving billions of dollars into a very specific set of assets. That meeting happened in late 2024, and if you understand what they bought, and more importantly, why, everything you think you know about the coming energy crisis will change completely. Here's what the headlines are telling you right now. Oil prices are volatile, geopolitical tensions are elevated, and experts are divided. Here is what the billionaires are telling you, through their actions, not their words. Something is coming that the public is not prepared for. And they are positioning themselves right now while the window is still open. Let me show you what they see that you don't. It starts with a strip of water 21 miles wide at its narrowest point. 21 miles. You could see the other side on a clear day, and through that strip, the Strait of Hormuz flows 1/5 of every barrel of oil consumed on planet Earth. Every single day, rain or shine, war or peace. It has flowed through there for decades without serious interruption. But here is the detail that changes everything. The last time that flow was seriously threatened, not blocked, not closed, just threatened, the American economy lost half its stock market value. Gas lines stretched for miles. Ordinary people fought each other at filling stations. Truckers shot at each other on highways. That was 1973, before China was an industrial power, before global supply chains existed, before the world consumed 100 million barrels of oil per day. The world is 4 times more dependent on that 21-mile strip of water today than it was then, and the billionaires know exactly what happens if it closes. Do you? Here's the first thing they teach you in geopolitical risk analysis. When powerful people stop talking about a risk, that is when the risk is most real. Think about that for a moment. When something is genuinely dangerous, when the people who understand it have already positioned themselves, the last thing they want is public panic driving up the price of the assets they are still accumulating. So they go quiet. And right now, the people who understand the Strait of Hormuz best are the quietest they've been in 20 years. Let me give you the geography first, because most people have never truly understood what the Strait of Hormuz actually means to the global economy. On one side, Iran. On the other, Oman and the United Arab Emirates. The waterway connects the Persian Gulf, where Saudi Arabia, Kuwait, Iraq, the UAE, Qatar, and Bahrain all export their oil, to the Gulf of Oman and the open ocean beyond. Every supertanker leaving Saudi Arabia passes through it. Every LNG carrier from Qatar passes through it. Every barrel of oil heading from the Persian Gulf to Europe, to Asia, to America passes through it. There is no pipeline alternative that can handle the volume. There is no bypass route that can be activated in time. If the strait closes, even for 30 days, the ripple effect hits every economy on Earth simultaneously. Now, here is the signal the billionaires are reading. In 2019, Iran seized a British oil tanker in the strait. Oil spiked 15% in a single day and settled back down. The market treated it as a temporary event. In 2024, Houthi attacks in the Red Sea, a different but connected choke point, rerouted over 20% of global container shipping almost overnight. The market treated that as temporary too. But the billionaires noticed something the market missed. Each incident since 2019 has been larger than the last. Each recovery has taken slightly longer to recover, and each time, the infrastructure that was supposed to provide resilience proved slightly less resilient than advertised. There is a pattern here, and patterns in energy markets do not stay invisible forever. But what specific assets are they actually buying, and why are those assets chosen deliberately to benefit from exactly the scenario the headlines refuse to discuss? The answer involves 3 sectors most ordinary investors have never even considered. Smart money does not bet on disasters. Smart money bets on consequences. There is a critical difference, and understanding it is the difference between panicking and profiting when an energy crisis hits. The billionaires are not sitting in bunkers hoping the Strait of Hormuz closes. They are simply asking one cold, logical question. If oil supply from the Persian Gulf is disrupted for any reason, what becomes immediately, desperately, enormously valuable? And they have identified 3 answers. The first bet, Western Hemisphere oil production. If Persian Gulf oil becomes unavailable or unreliable, even temporarily, every barrel produced outside that region becomes exponentially more valuable overnight. Canada's oil sands, the Permian Basin in Texas, Brazilian deepwater fields, Norwegian North Sea platforms. These are not exciting investments in normal times. They are boring, steady, unglamorous energy producers. But in an energy crisis, they become the most strategically critical assets on Earth, because they are the only barrels that do not pass through the Strait of Hormuz. Since early 2024, institutional money, the kind that moves in billion-dollar blocks, has been quietly accumulating positions in North American energy producers at a pace not seen since 2007. That is not a coincidence. The second bet, strategic storage infrastructure. When supply is disrupted, the entity that controls existing stored inventory controls the price. Oil storage facilities, LNG terminals, strategic petroleum reserve adjacent infrastructure, pipeline capacity in non-Gulf regions. These assets are boring. They generate steady, unexciting returns in normal times, but in a supply shock, they become choke points of a different kind. The kind that generates extraordinary returns for their owners while everyone else scrambles. Follow the infrastructure money. It is moving faster than at any point in the last decade. The third asset class the billionaires are quietly accumulating is agricultural commodities and food production infrastructure. Stay with me, because this is where most people disconnect, and that disconnect is exactly why this opportunity exists. Here is the link that most people never make. Modern industrial agriculture runs on oil, not partially, not significantly, fundamentally. Every tractor in every field burns diesel. Every fertilizer plant on Earth runs on natural gas, a petroleum product. Every food shipment traveling from farm to grocery store burns bunker fuel. Every pesticide, every herbicide, every plastic packaging material, petroleum derivatives. When oil supply is disrupted and prices spike, food production costs spike within weeks, food prices spike within months, and the populations most vulnerable to food inflation become politically unstable within a year. This is not speculation. This is the documented history of every major oil shock since 1973. After the 1973 oil embargo, global food prices rose 50% within 18 months. After the 1979 Iranian Revolution disrupted oil supply, food inflation accelerated across every developed economy. After the 2008 oil price spike to $147 a barrel, food riots broke out in 48 countries simultaneously. The billionaires know this chain reaction by heart. They have studied it, they have modeled it, and they are now buying the assets that sit at the beginning of that chain, before the oil shock triggers the food shock, triggers the political shock. Farmland in the American Midwest, grain storage and processing facilities, fertilizer producers with long-term natural gas contracts already locked in, agricultural equipment manufacturers with 18-month order backlogs. Bill Gates is now the largest private farmland owner in the United States. That fact was reported, briefly discussed, and then forgotten by most people. The billionaires did not forget it. Now, here is the 2026 timeline and why the window may be closing faster than anyone in the mainstream media is acknowledging. 3 simultaneous pressures are converging on the global oil supply system in the next 18 to 24 months. The first is geopolitical, the second is structural, and the third, the one that makes energy analysts genuinely nervous when they speak privately, is the one that cannot be fixed quickly even if every political decision goes perfectly. 3 pressures converging simultaneously by 2026. Let's name them clearly, because clarity is the only thing that separates the people who act from the people who watch. Pressure 1. Geopolitical ignition risk.
The Middle East in 2025 is not the Middle East of 2015. The Abraham Accords that began normalizing Arab-Israeli relations have stalled. Iran's nuclear program has advanced further than at any point in its history. And the Houthi campaign against Red Sea shipping has demonstrated that non-state actors can now meaningfully disrupt global trade routes. And the Strait of Hormuz, that 21-mile channel, has Iranian military installations on its northern shore, missile batteries capable of hitting supertankers, and a government that has explicitly and repeatedly threatened to close it if pushed to the edge. The ignition risk is not 100%, it never is, but it has never been higher in the post-Cold War era. Pressure 2. Structural underinvestment. Between 2015 and 2023, global investment in new oil and gas production fell by over 50% from its peak. ESG mandates, energy transition narratives, and regulatory uncertainty caused major oil companies to dramatically reduce exploration and development spending. The result? The global spare production buffer, the emergency reserve the world uses to absorb supply shocks, is at its lowest level since 1973. In 1973, when the embargo hit, the world had limited ability to increase production quickly. Today, the situation is nearly identical, but the global economy is 4 times larger and 4 times more oil-dependent. Pressure 3. The demand surge nobody is modeling correctly. AI data centers are consuming electricity at a rate that is overwhelming renewable capacity in every major economy simultaneously. The result? Natural gas and oil-fired power generation is surging back, just as the political narrative insisted we were moving away from it. India and Southeast Asia are adding middle-class consumers at a pace that adds the equivalent of a new United States of oil demand every decade. And the electric vehicle transition, which was supposed to reduce oil demand, is happening 40% slower than the International Energy Agency projected just 3 years ago. 3 pressures, 1 choke point, a world less prepared than it has ever been. So, what do you actually do? Not financial advice, but here is what the pattern of history and the movement of serious money suggests. Diversify energy exposure away from pure price speculation and towards infrastructure and production assets outside the Gulf region. Understand that food security and energy security are the same crisis wearing different clothes. And recognize that the window between awareness and opportunity is always shorter than it appears. In 1973, the people who understood what was coming had roughly 6 months between the first signals and the moment the gas lines formed. The first signals for 2026 are already visible. The billionaires are not reading headlines. They are reading shipping manifests, satellite images of oil storage facilities, and private intelligence reports about Strait of Hormuz naval movements. You cannot access those reports, but you can watch what they do with the conclusions. And right now, they are buying. The question is not whether an energy shock is coming. The question is whether you will be positioned before the headlines finally catch up to what the smart money already knows. Subscribe. And if you want to understand exactly which specific sectors have outperformed in every previous energy shock since 1973, that breakdown is in the next video. Do not wait for the gas lines to form before you start paying attention.